Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. The resilience of the economy is a matter of debate, with different cases to be made depending on the data. When it comes to the Fed's favorite reports, the data hasn't given them any reason to go easy on rates. The Fed doesn't directly dictate mortgage rates, but it does set the Fed funds rate, which has an indirect effect on mortgage rates. Financial markets can also bet on the future level of the Fed funds rates via securities called Fed funds futures. This allows the market to consistently adjust, whereas the Fed only makes changes on a scheduled basis 8 times per year. Here's how the implied Fed rate has shifted recently for the December 2022 and June 2023 meetings. The Fed funds rate, it only applies to the shortest term lending, which is one reason it's not always highly correlated with mortgage rates, because mortgages are long-term loans. Longer-term rates can move in very different patterns compared to short-term rates. But longer-term rates often line up much better with those longer-run Fed rate expectations. The next chart shows the June Fed funds expectations overlaid with 10-year Treasury yields, which is the quintessential benchmark for longer-term rates in the U.S. The previous chart is not a perfect match at all times, but it has been highly correlated in the past few weeks. For even better correlation, I can compare treasuries and mortgage rates, which, as of Friday, moved back up to the highest levels in 20 years. That's a question that I've been answering again and again throughout 2022, but the answer hasn't really changed in terms of its essential ingredients. They are as follows: incredibly high inflation, remarkably resilient economic data, and a long stint of incredibly rate-friendly Fed policies that require unwinding. This rate-friendly policy is why some economists are saying this recession was avoidable, and I tend to agree with that assessment. Now, because of this long-term rate-friendly policy, the Fed has to make drastic changes to the Fed funds rate to bring the markets back in line with reality. The Fed's sense of urgency is higher than it otherwise would be due to parallels it perceives to 1980, when the Fed Chair Volcker cut rates from 16% to 11% at the first sign of lower inflation, only to hike them to 19% 2 months later when inflation proved resilient. The initial rate cuts by Volcker were widely criticized as a Fed policy error, one that multiple Fed speakers have recently vowed to avoid in the present. In other words, the Fed is determined to hike rates as high as it can and keep them there as long as it can, even if that means the economy suffers. And in fact, the Fed actually wants to see a measured amount of suffering in order to confirm that it has hiked rates enough. I personally think that the Fed should pause to see the market adjust to the recent increase in the Fed funds rate, as it has been pretty dramatic in less than a year. Now, to make matters worse, they're not really considering the mortgage or housing market in that endeavor for 2 reasons. Home price appreciation got way ahead of itself, I should say, by rising roughly 40% over 2 years. The Fed knows rate policy changes will generally have the most immediate effects on the housing market, so it would be prepared to overlook an initial correction in lending volume and home prices. In the current case, the Fed sees charts like the following and concludes that it is a good and necessary thing for housing markets to be cooling off. Just keep in mind The housing and auto sectors of the economy are the two most influential sectors of the economy. So to cause too much pain would have a long-lasting effect. Housing, mortgage data notwithstanding, the rest of it has yet to send any red flags serious enough for the Fed to reconsider its unfriendly stance on rates. Again, why I think there should be a pause as to let the economy breathe a little before your next move. That's not to say there aren't some signs of contraction in major economic indices, but so far it's been the manufacturing sector more than the servicing sector, and it's not uncommon for the manufacturing to oscillate in more frequent boom-bust cycles, even as the broader economy chugs along. Both of the big ticket purchasing managers, PMIs, from the Institute for Supply Management, ISMs, were out last week. The resilience in these servicing sectors means the Fed is far from concerned. Both lines would need to be moving into the contraction zone for that to change. Now, we also received the latest update on the labor market via the big monthly jobs report. Apart from the big inflation indices, the jobs report is the most significant report for the Fed, and one that it's certainly being watched for the desired signs of labor market weakness. Fortunately for people who like jobs, but unfortunately for the interest rates, the numbers remain anything but weak. Keep in mind the labor participation rate also dropped, helping to keep this number strong. Granted, that average job count will likely continue to drop, and the strength hasn't yet offset the post-COVID weaknesses when it comes to where we would have otherwise been, but the point is that the job creation at current levels is still higher than the Fed expected it would be. Perhaps more telling and much easier to understand would be the fact that the unemployment rate is back to the lowest level since the 1960s at 3.5%, after bumping just a bit higher last month. Again, this is due in part to the dropping labor participation rate. Now, although there are a few holes in the economy and windows of things yet to come, the Fed has been so clear about its intentions, and some reports do point to a stronger than expected economy. These conflicting reports are what is causing the uncertainty and volatility in the markets. It's clear the Fed is siding on the strength of the reports, not the data behind the reports. This means that once the numbers do shift, they will shift quickly, and it will be at that point we'll finally see a softer side of the Fed. Let's just hope they can react quickly. The major inflation industries are the most important reports right now, with the consumer price index being head and shoulders above anything else in terms of importance. Very close second is the jobs report. The all-important CPI report comes out this Thursday, and it may well have the power to decide if rates hold the line with the ceiling of 20-year highs or punch a hole up into the second floor. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.